Guys, you deserve the truth, the good, the bad, and everything else in between. So I want to go over where we currently sit with this AMC trade. How long is it going to take until we do inevitably see the short squeeze? What's going on in the global financial markets? Why am I so personally excited about what is to come for AMC stock? It's not the fact that we closed above $16 yesterday. That's not the case. That's very bullish, but you can't look at this on a day-to-day basis or even a week-to-week basis. You really have to look at the macro environment that we are currently in. I have been very consistent here on this channel saying you will not see the Moass, the mother of all short squeezes, until liquidity is restricted. What is happening every single week? Liquidity is being restricted in one form or the other, and that's really the focal point of this video, is liquidity being restricted. When is that actually going to happen? How long is that going to take? And when is the Moass going to happen? But on a side note, I want to go over one of the funniest comments I have seen in a very long time by WM. I unsubscribed today. Distraction from AMC. You are done. And this was about the Mullen video that I made yesterday. And then Matthew Wagner says, LOL, bye. I am thanking TCI for his stream for my current 75-cent Mullen position. And of course, I get it. It's not really a distraction, but then again, I could see where somebody would say that. And you got to realize, money is going to go where money goes. If you want to be a one-trick pony, you want to sit in this stock no matter what happens. I mean, I put $350 into Mullen. I'm up $1,500 on that. And I have tens of thousands of dollars in AMC. So take that for what it is. If you guys don't want those kind of videos, it's best you unsubscribe now. Just going to put that out there. We are here to make money, nothing else. We can be friends, we can be cool and all that, but we are here to make money, and wherever opportunities are presented, I'm going to bring that to you guys, no matter who likes it or who hates it, because I have a passion of making you guys money and making these videos. So nonetheless, let's get into all of this key information. If you guys find value out of it, feel free to hit the like button, subscribe to the channel, and get yourself those free stocks. Links down below in the description. And if you guys want to come trade with us, get in on Mullen Automotives at 70 cents per share, or buy Snapchat calls that were up 500% this week, or the SoFi calls, or the JP Morgan calls of last week, and many other trades. Come check that out. It pays for itself over and over again. I really should up the price because it's so inexpensive and it pays for itself so many times over and over again, almost every single week. It doesn't make sense to keep it that cheap, but I like to help you make money. But besides that, let's talk about what's going on in the markets. Now, it's very important to realize, and I want to be straightforward with you guys, because after all, you deserve the truth. And we've seen the first rate hike. A lot of people thought the markets would sell off on that. I believe, the only person in this community to be saying we're going to see a bullish reaction after the Fed. I was very clear, very transparent about that. I traded my portfolio along that same thesis and was rewarded nicely for that. Not trying to pat myself on the back here, but there's a way the markets operate. I've been investing in the markets for a very long time, so this is not my first rodeo, for lack of a better word, in the markets in highly volatile, uncertain times. What happened is that we got that rate hike we were expecting to see, but at the same time, the Fed was very bullish sounding on the economy. The Fed said that you would have to do, or they would have to do, significant rate hikes. They would have to Paul Volcker us, which he was the Fed during the times of very high inflation, and raise interest rates to about almost 20% to combat inflation. That was Paul Volcker. So if you guys ever hear that name, that's who the Fed chair was during this time. And he had to do what he had to do to get inflation down after we left the gold standard. So besides that, the Fed said the economy is very strong and there's a very low likelihood of actually seeing a recession. But the Fed has been wrong many times, including right now when they should have raised rates over a year ago, far beyond the curve. Is the Fed right? That's the simple question. And what does that do for liquidity? Well, when the Fed raises rates, especially the first time, the markets historically do rally off of that. And if you do take a look right here, it says historical patterns suggest that while stocks tend to fall in the month after a rate hike, they end up recovering to see solid gains within a year. The markets do not actually crash off of raising rates until the rates are raised multiple times. And we'll go over the data and the facts here, because that's not a trust me bro statement. That's a definitive fact, and we have data to back that up. But what does that do for liquidity? Well, every time the Fed raises rates, it doesn't do all too much, honestly. Raising rates is the rates that the banks pay each other to borrow money from each other. So the federal funds rate is, say, JP Morgan needs $1 billion from Citibank or Bank of America, though they have to pay now in between 0.25% and 0.5% for that money. So then it kind of passes that interest rate to you guys a little bit, but it's not a 1-to-1 ratio. Even for mortgage rates, it's not a 1-to-1 ratio, but that cost goes up. So you tend to see your treasury bonds go up, which is really what your loans are based off of, like your auto loans or your home loans. You'll see that the average mortgage rate is now over 4%. I got a mortgage about 9 months ago for about 2.85% interest rate. So that's what starts to restrict liquidity. The margin payments that hedge funds, institutions, anybody in the investment world has to pay is going up. My personal margin went from 2.5% to 3% just based off of this 0.25% rate hike. So that's a form of liquidity that is being sucked out of the markets, and that's probably the biggest form. Now, when you start to see these rate hikes back to back to back, we're pricing in, and the Fed has told us they expect 7 rate hikes this year, you will really start to see those margin rates, those rates to borrow money going through the roof, and that's what really puts a dampen on a lot of the speculation in the markets, but the cost of maintaining these margin loans. I think a lot of people forget to realize that a margin loan is pretty much a revolving line of credit. So if these hedge funds have all of these margin loans, which they obviously do, we have the data to prove that as well, then their cost to maintain those margin loans, those short positions, just went up 0.5%. Likely 0.5%. It went up for me 0.5%. You know, it probably went up for them at least 0.5%, depending on your risk there. You know, banks might get better treatment, but still, it's going up a lot. And when you're talking about billions of dollars, that really does start to have a big impact to hedge funds and institutions, and does start to kind of make them think twice about what they are doing in the markets. That's the first thing. But what about, you know, the markets actually selling off because of this? When will that happen? And here's really the data to show what I'm saying. So we're just going to look at recent times here. So back here in 1999, I say recent, this was the year I was born. I'm turning 23 April 1st. So 1999, we seen the rates. They were at about 4.74%. They jacked rates all the way up in about 6 months to about 6.5%. What happened? Recession happened after the rate hike cycle. And the recession is right here in the gray. You see that? Right here, right here, right here. Pretty much every time they raise rates, it doesn't happen the first time they raise rates. We don't go into recession. It happens after they raise them multiple times. It could be a couple times, or it could be a lot of times. Even back here, take a look at 03, 1% interest rates. That was pretty much the floor right here. During this about 6-month period, Fed started to raise rates from 1% all the way up to 5.25%. And then what happens? Recession hits. Now what happened over here? Fed started to raise rates from 2015. They were pretty much at 0 since 08. Started to raise rates quite aggressively. And then boom, they started to actually cut rates in the end of 2019. That's what actually made the markets crash, because they were kind of freaking out there for a while, and then the markets did recover, you know, because if the Fed ever does anything aggressively, raises rates or cut rates, it's a big red flag. And then what happened? the COVID pandemic. And you can see that small little recession right there. The rest is history. So it's not necessarily this first rate hike that we're going to sell off and we're plummeting into the ground. It's a process here. But we are experimenting with modern monetary policy. This is either going to be a big win for modern monetary policy, or it's going to be a big L. It's going to be a big loss. We don't know what happens when you print trillions and trillions of dollars in a 2-year time frame and then suck that money back as fast as possible. We don't know. So we don't know if it's going to take a long time, if it's going to be a short time. My personal opinion here is if you look at something like a good old Apple that reports tens of billions, hundreds of billions of dollars in revenue per quarter, I think without that extra stimulus here, it's going to be very hard to maintain growth at the largest companies in the world. Like Apple, last quarter, they just reported $124 billion of revenue. Even if we take a look at Q1 2021, they reported $111.44 billion of revenue. Q2, $89.58 billion of revenue. So that's going to be important once we do get into this next earnings, which is going to be April 28th. What is Apple's numbers going to look like now that you don't see that much stimulus out in the economy? That's really what is going to cause the panic here, because the markets, they always revert back to those fundamental levels. If you can get a stock significantly under its fundamental valuation, like AMC, like SoFi, like a lot of these stocks that rallied on Friday, like substantially rallied, then you'll inevitably see them return back to that fundamental valuation. But when you start to see the fundamental valuation going down, that starts to put pressure on all of the collateral the hedge funds have been using to service and basically put up for these margin loans for their short positions. So, okay, we got that. We get that, Tyler. You probably said that. I probably said that before in multiple videos. It's good to be reminded of this because I don't think too many people actually go into the economics of how this actually works and how it affects hedge funds and institutions. Like I said in the beginning of this video, you have to look at the macro environment here. But if we take a look at the direct exposure from Western banks, this is only Western banks to Russia. Societe General, I'm not sure if that's a French bank or whatnot. It really doesn't matter. It's a Western bank, so it's not related to Russia. It's Europe, right? Total exposure, they have almost $18 billion. Raiffeisen, I believe that's a French bank or an Italian bank. They have $22.9 billion of exposure. Unicredit has $7.4 billion of exposure. Citigroup has about $9 billion of exposure. So these are pretty much all losses at this point. So you just lost a lot of money in the banking segment. A lot of Europe is going to be hit very hard. Citigroup also going to be hit very hard. That's almost 10% of Citigroup's total market cap. But besides that, guess what the largest holders of Russian debt are? Foreign sovereign debt. Italy, America, France. We have about $25 billion apiece worth of Russian debt. And what happens when Russia defaults on that $2 billion US denominated bond payment on April 4th? Well, you're going to see shock hit the markets. It's not going to be a big shocker that it happened, but it has not happened since 1917 to Russia. So it's been a very long time. You're talking World War I was the last time this actually happened. And who knows the effects that this will actually have on other countries, such as China, that does not publicly disclose all of this data. The exposure might be a lot more. And then on top of that, add the derivative exposure here, because I've said this a couple times, but I don't think a lot of people actually know this. During 2008, it wasn't people that stopped paying their mortgages that crashed the global financial system. It wasn't that. We had a 12% basically eviction rate, right? People that stopped paying their their mortgages, which is very, very high. That's still a big problem. But what the real problem was banks that were betting on these bad assets. Russia, like I've showed in videos before, like I've shown on the live streams before, Russia has a very low debt to GDP ratio. So they were a very safe, relative safe country to invest in, to get paid a lot of interest for investing in them, like triple or 5 times, depending on, you know, when you actually purchase your securities, your Russian treasuries, about 3 to 5 times the amount of interest you get paid for American bonds. So why not? That's why a lot of banks have a lot of exposure to Russia. All of this, losses. And what does that do for the world? It helps to exacerbate an already bad situation that is going on in the world. Europe heading into a recession. China in a credit crisis, and that is really, really bad. Financial media does not talk about it a lot, but do some research, some due diligence. The Chinese stock market is at their 10-year lows, way lower than March of 2020, and they're having this COVID spike. Who knows what that will do for their economy? Add that on top of his cherry on top of your sundae type of deal. And then America facing highest inflation in 45 years, facing a Fed that is going to be raising rates at the most aggressive pace they have in over 10 years, whereas the borrowing costs are going up for all loans. Anything financial is becoming more expensive to borrow money. Put all of this together, and you're looking at a very bad situation that I think will start to play out once you start to see large companies like Apple reporting earnings later in April and then in May and in June. And I think that that's going to be a big domino to fall. And then I think you're going to see a lot of weakness, especially the earnings after this earnings that really happens in summertime, end of summer, and then you will ultimately see the prime conditions to see the Moass end of summer throughout fall. That's my personal projection. That's when I think we will see the Moass, because it's not about, you know, what the price of the stock actually does. It's about what the macro credit situation looks like. If AMC goes up 100% in a day, being dramatic here, right? It doesn't matter if people have a ton of money to service their margin calls. But when Russia defaults, they lost all that money when it's very hard and very expensive to get your hands on access to money, right? To even service a margin call. When you see China is in just dire straits by that time, they're going to be in a very bad situation, as well as Europe already in a recession at that time. It's already starting right now. You're looking at a very bad situation for the markets, a very good situation for AMC coming during that time frame, end of summer throughout the fall. Now, we do have one very bullish catalyst that is inevitably going to come. Russia cannot afford this war that they are doing in Ukraine. If Ukraine can hold out a little bit longer, a couple more weeks maximum, Russia will have to stop what they are doing. It happened, you know, in the 1850s. It happened in World War I. Russia runs out of money. Historically, they go into wars, run out of money, and then have to end the wars. So that's going to happen, but on a much faster pace now, and that's going to be a very bullish catalyst for the markets. Can't tell you guys when that is actually going to happen. Couldn't even throw out a date there. Could be in the next couple of weeks, could be in the next 2 or 3 months, but it's going to happen, and that's going to be the single biggest bullish catalyst that I think we will have in the next couple of months. So I hope that made some sense, you guys. I hope that resonated with you, and I hope you find value out of it. So if you do, if you want to be a part of that and any other trade that we make, Mullen, or any other opportunity, hit that like button, subscribe to the channel, comment down below what stocks are you looking at heading into next week. What is your thoughts about this? When do you think the Moass is going to happen? Let me know all of that key information. Get yourself those free stocks, links down below in the description. And if you guys want to come join the trading community, get access to all of my trades in real time, as well as just join a great trading community. Come ask questions, come learn, come do all of that. It's a resource for you guys, very inexpensive, that you can be a part of. So if you guys want to be a part of it, link down below in the pinned comment. Thank you for watching, and I will see you in the next one.